All right. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker AMCX, AMC Network. Pretty excited to get into this one. There's definitely been lots of discussions about this stock pretty much the entire time that I've been an investor. I remember really when I first started getting investing in 2018, 2019, considering taking a look at this and kind of bypassing it, partially just because I didn't really think that it particularly had a whole lot of great value to it. I didn't have a whole lot of confidence necessarily in the brand or the franchises related to said brand, being that it is a entertainment company, broadcasting company, and also now a streaming service company. But it has only become a deeper and deeper value according to a very, very traditional kind of multiple metrics. And so people's interest in it has grown over time, enough so that I kind of eventually caved and decided to take a look at it for better or for worse. So here in front of us, we have our watch list of other companies that we've valued here on the channel. Kind of taking a quick look at that and commenting on it. I did buy some more Smith & Wesson this week, as well as I bought a little bit of Intel. That one I haven't purchased in some time, but I did actually buy a little bit more Intel this week, and also a little bit more Interfor as well, and also some Turtle Beach. So I've been making some purchases on my usual Monday purchases, as I typically do, as well as on other more macro related and hedging related positions that I don't particularly comment on too much on the channel, but the vast majority of my portfolio being individual companies. Those are the parts I typically talk about. And one other detail I kind of wanted to comment on before getting into the main valuation, that being the valuation that I did on ZIM, Zim Integrated Shipping, which I did very recently, which it as a live stream, as a video for the channel, it's performed extraordinarily well. It's actually quickly became our most watched live stream by far and away, multiple times over. And there's been a whole lot of positive support for it, lots of likes, but also lots of criticisms in the comments, of which I've definitely taken a look at and commented on a few of them, and definitely tried to absorb some of the details of it. But I did kind of want to point out that it did seem that some of the people who were noticing my numbers for the valuation itself kind of had a perspective that I was saying that perhaps the company was basically going to be going out of business or something like that, which was definitely not the implication I was trying to make. I do have the belief that their revenues 5 years out are going to be dramatically lower than the current revenues because they've spiked up so much more. But even so, I do see the company as being in business 5 years out, regardless of the default risk that they have associated with the debt in their business. In fact, the way I think about default risks, this is the part that I think most people got hung up on, is that I had assigned to them approximately 4.5% chance of defaulting per year. But a default risk does not imply that the company itself is going to go out of existence. It just means that they're going to have to restructure and reorganize their debts. And when doing so, the equity investor is the person that typically takes the slack for that. So it doesn't imply that the company itself is going to go out of business. And so some people kind of took issue with that me saying that there was about a 25% chance over a 5-year period that they would default and go bankrupt. But that doesn't mean that the company goes out of business. It just means that the equity investor is going to be screwed. That doesn't mean that the company is going to be gone. And also, it's worth noting that people were kind of acting as though that I said that the stock was a bad valuation, when if you had actually noticed what I ended up with as a result, I ended up saying that the stock was actually a great valuation. Granted, this was also prior to them having a very large drop not too long after I had done that valuation. But that's associated with the fact that they had gone ex-dividend date. In fact, I had commented that in that live stream that once they did go to ex-dividend date, they would drop by approximately the percentage amount that the dividend was. And since it was like 35-40% or something yield, that meant there would be an expected 10 to 15% drop on the ex-dividend date, which definitely did happen. In fact, it's dropped a little bit further since then. So I think some people didn't fully understand some of the details in my valuation. I kind of wanted to comment on that a little bit further. One other thing I kind of wanted to get into a little bit before getting into the valuation that we're covering today is the economic data that was reported today. There was the consumer price index information that was released today, which there was a lot of downward movements in the market today as a result of that. It did come out worse than expected, being that the headline number for the CPI came out at 8.3% on a year-over-year basis, with the month-over-month being a positive 0.1. It was expected to be a negative 0.1 as the month over month, which would have been year over year of 8.1, I believe it would have come out to do. So it wasn't even that much higher than expected, but the fact that it was higher than expected did lead to such a downward move in the markets, partially because people had kind of put it in their minds that we were going to start to see this downward trend in the CPI. Even so, the overall CPI number, that was, like I said, I wouldn't necessarily consider that to be a bad CPI number on the headline number, but the core CPI numbers where things start to get a little bit more shaky, which is things that I've commented on the channel multiple times, which is to say that we have this the shelter line, which includes all the costs of housing in the CPI measure, has been far and away backtracking and not catching up with the movements in the housing prices. In fact, that started to pick up speed and accelerate forward. So I did actually want to pull up some information to kind of belabor my point about why I think the CPI has not necessarily reached its peaks and why it is that the CPI numbers basically led to such a downward movement in the markets today. I did also want to comment, basically, this is the commodity index. So this is a decent portion of the CPI numbers is going to be related to the movements in commodity prices, but definitely not the core part of it, but the overall headline number. And I had commented on this about a week or two ago in my own projections, so that I had thought that the CPI number wasn't going to be downward move. I thought it would be flat. So even so, it was a little bit higher than my expectations. My argument had been that during the month of August, the commodity prices actually hadn't moved downward at all, particularly. So there wasn't particularly any reason to think that there would be too much of a downward movement in the CPI. But we're already about halfway through the month of September, and even so, the commodity prices also haven't really moved down that much. They've moved down maybe slightly on average, but not that much. And again, half of the month is still to go, and that's just commodity prices. That doesn't take into account services and other factors like that. So taking a look, for example, on the Federal Reserve website, this is the actual CPI rate. The blue line, the year-over-year number, is the 8.3 that we're talking about, and then this is it minus food and energy, which is the core number that we're talking about. So you can see that even so, on a year-over-year basis, it did come down, but not quite as much as people were expecting because of the rebasing of the numbers. However, the core number has moved up, even regardless of that fact. If we switch over specifically to month-over-month figures for that, so you can see that the rebasing, exactly what I'm talking about, people were expecting the core number to actually move down a little bit more relative to the really large upward movements in month-over-month from the year prior to that, but the core number is still a little bit higher than that. If we focus specifically on just the section of the consumer price index which has shelter, which includes both regular housing as well as rental housings. It also includes lodgings away from home, but that's a relatively small weighting, so I don't think it has a major factor. You can see that this has made no slope movements in the slowdown whatsoever. And also, if we compare that number to the year over year of the housing price index, you can see that the housing prices have actually moved up far faster than the actual rents and the cost of housing in the CPI number, which is to say that I don't think the CPI number has reached its peaks because, well, this would have to measure up for that. For example, if we go back to 2008 when the housing prices came down, you can see that from the time when the housing prices had finally reached a year-over-year downward movement, which was in the beginning of 2007, it took about 2 years for rental prices to actually start to reach a year-over-year downward movement from that point onward. And obviously, it still continued from there. And the year-over-year movements in the housing prices, while still lagging from about a month or two ago relative to the rental prices, they themselves are still at positive about 18%. So I would say that means we're a year, 2, maybe 3 years away from the rental CPI numbers possibly going into negative territory. In fact, I expect them to continue to accelerate for the time being. And this is also, I wanted to point out to show that the probabilities implied in the federal funds rate futures have shown that the market is starting to price in the possibilities for a 5% federal funds rate, possibly in late 2023. Very small percentage chance so far, but even so, it shows that some participants in the market are really starting to see that is actually a possibility, with the bulk of the probabilities still weighting between 4% and 4.5%. But only a week ago, it was much more solidly around the 4 to 4.25%, and didn't have this solid deviation towards 4.25 to 4.5%. And there's also been some headlines even today about the possibility that when the Fed meets in the next week, that they might even do a full percentage point. But I don't necessarily think that's necessarily super likely. And even so, here today, we have the federal treasury, the 10-year treasury up to 3.42%, which is almost up to the peaks that it had spiked up to back in June before it started to have a little bit of a retracement. So even so, it looks like the longer term trend is upward. So that's enough talking about economics and inflation, and interest rates and details about that. But I did kind of want to talk about those things because I do think that those are very, very relevant to understanding what's going on in the market and why it is that we should definitely be expecting more downward movements in the market in general, in my opinion, for the rest of the year, especially with the Federal Reserve so adamant on fighting inflation, because I definitely don't think that we've reached peak inflation, regardless of the last month or so of people's kind of optimism in that regard. So getting into AMCX, AMC Networks, they were founded in 1980, and they're on the New York Stock Exchange. Main currency being in USD. They are a US incorporated company. I have their main websites listed here. They recently actually appointed a new CEO, Christina Spade, who was previously their COO and CFO. It was kind of like a dual position that she had operated for a relatively short period of time, about a year and a half. It looks like looking through their history, AMCX has kind of been going through a lot of corporate changes over the last few years as they've been trying to evolve their business from a more traditional entertainment broadcasting provider into a streaming service entertainment provider with their kind of specialized streaming brands, which I had kind of started at the beginning of the stream. I definitely didn't have a whole lot of optimism for them a few years ago, and I wouldn't say that in general they performed better than I had expected in regards to that, as far as like actually maintaining a few of their franchises, specifically talking about like the Walking Dead franchise and the Better Call Saul franchise. Like those continue to have more seasons than expected, and they have further spin-offs in the works, as well as other series that they're working on as well, that I definitely didn't think necessarily were going to do as well a few years ago. So the point is, at this point, I now see slightly having a little bit more optimistic of a future as far as some of those franchises go. I definitely still don't see them as having a very strong position in this industry as a whole. I look at them as definitely one of the weaker contenders, and at the end of the day, I think one of the best opportunities possibly for the shareholders of the company is to maybe eventually get bought out by one of the larger players. Possibly, I don't know, unless they can possibly strike gold with another major series like that. But even so, doing spin-offs of The Walking Dead and Breaking Bad forever, I don't think is necessarily something that they can do. Like I said, I've just been impressed with how well they've done it so far. It was better than expected, but I still don't necessarily think it's something you can do forever. So major competitors obviously being the other streaming players, but other broadcasters and entertainment providers: Netflix, Disney, Paramount, Comcast, Apple, and also including Roku and Fubo, and there's other players you could list as well. They recently reported the numbers in August. The expected next reporting date is in November, the start of the month, relatively speaking. You couldn't find specific revenue guidance. The only particular guidance that they seem to provide is their kind of longer term targets that they have for AMC Plus, which is their streaming service platform, which combines all of their previous separate broadcasting channel brands that they have all into kind of one place, including AMC and Sundance and IFC, as well as BBC America and a few other of their more specialized sub brands. But anyway, they're trying to target 20 to 25 million in streaming subs by 2025. I believe the most recently they had 9.1 or something million or so. So they're roughly halfway, or a little bit less than halfway, towards their overall target of 2025. And they've been kind of at it for like a year and a half or so. So, I mean, that's pretty good in terms of it trying to reach their target. I would say that the target itself is not entirely super impressive. And then also it's worth noting that like the whole purpose of this is really them cannibalizing their previous business. Like obviously that was true of Disney, and so it's kind of like similar in kind of story and form in previous valuations that I've done, because I've valued Disney a few times before. So like in terms of like thinking of it like that, it's a little bit similar in terms of like Disney's kind of cannibalizing one of their businesses to feed the growth of this new business, and the hopes is that they might be able to have higher margins or a better capital setup for the overall industry. And whether or not that actually pans out remains to be seen. But the point is it's basically the same thing for AMC Networks. The only difference is that AMC doesn't have quite the same dispersion of other revenues to kind of feed that base, such as like the amusement parks and other such things like Disney has. But regardless, 20 to 25 million subs to 2025 is essentially what they're aiming for. The analysts on Yahoo list 3.12 billion as the expectations for 2022 total revenues, according to 10 analysts, and 3.17 billion being the expectation for 2023, with adjusted EPS for 2022 according to 8 analysts being $7.73, and then $7.11 according to 9 analysts for the year after that. They do not have a dividend, so no trailing or forward dividend, but they do have $135.3 million in share authorization for buybacks, which equates to 12.65% of their overall market cap. However, in the last quarter, they didn't do any purchases whatsoever. So how quickly they're necessarily going to do that remains to be seen. They might be a little bit more judicious about it. I didn't actually go and take a super close look at the previous buybacks to take a look at how well and how efficient they've been in their purchases per se. But it is also worth noting that that's not necessarily going to be relevant information because, like as I was saying before, we have a new CEO with different management designs, hopefully, and so that's not necessarily going to have the same management perspective. In fact, the fact that they didn't do any share repurchases during this month when they were getting the new CEO makes sense, or this quarter when they were about to get the new CEO makes sense, perhaps, so that they can kind of put things in place for her to take off. Not to mention, like I said, she was also primarily a finance person, so hopefully she'll be in position to kind of direct the company financially into a better position, because not only are they trying to grow within an industry, but they're also trying to manage a relatively complicated capital structure, which we'll definitely get into when we get into their finances. But I mean, I guess it's not really a huge spoiler to say they have a lot of debt, so possibly having an accountant at the helm is not necessarily the worst idea in the world. But being relatively slow and judicious about buybacks would also probably be a good choice. But it is also worth noting that, as we'll get into when we get actually hitting the rest of the valuation, that the valuation is also pretty good. So it would also probably be a good time to be doing share repurchases. So there is kind of multiple angles to take on this. On one hand, paying down debt is going to be like the free ticket to excess free cash flows in the future by removing that obstacle to them, but also by also maybe taking advantage if you can of the lower prices that they have right now. But anyway, moving beyond that, there is a relatively elevated amount of insider holdings, about 12.25% of the overall flow, which gets into discussion of the share structure that they have, and frankly, kind of you can kind of divide that up into different ways. I don't think that's right, I didn't pull that page up for on the 10K, so I'll just kind of talk about it. But they do have a dual class share structure with A class and B shares. The AMCX is the A shares, while there is a larger amount of shares being held by the Dolan family, which they effectively have a control of the voting ownership between their ownership of the A shares and the B shares. In total, it gives them approximately 79% votership. So it is worth noting that when you invest in this company, you can't really invest in it on the assumption that even with a new CEO, that there is necessarily going to be a dramatic changeover in the business operations. The only level of changeover in the business operations that is likely to be seen is any level of it that is approved by the Dolan family, because they have essentially enough controlling voting shares to make it so that whatever happens in the business is whatever they want to happen in the business. So that means if they want share buybacks to happen at the expense of the shareholders, that's what they'll do. If they want to take on more debt at the expense of the shareholders, that's what they'll do. If they want to do the smart thing because it benefits them and the shareholders, that's what they'll do. But like I said, it's dual-edged sword. That's not necessarily a problem, but it could be a problem. But the point is that it does mean that there is a significant amount of shares that are not necessarily going to be widely traded because of just how much of those people's wealth that effectively that becomes a portion of. So we can effectively see that the overall float of the company is going to be smaller as a result of that, which has another effect because of the fact that they are also relatively highly shorted. We can see that there is about 6% of the shares outstanding that are currently being shorted, but if you take into account the portion of shares that are not in the float due to the ownership structure that we're talking about, is actually about 14% of the float that's currently shorted. So a little bit of a higher portion of that. Not to mention that, but there's also a relatively high short ratio currently, 9.51, and that's off of the back of the 3-month average volume was about 0.33 million shares versus the 10-day average volumes being a little bit more of an elevated level of a little under 500,000 shares. So there has been relatively high buying in the last week or two relative to the last 3 months. And there is relatively high shorting. And the 9.51 short ratio means that it would take 9.51 days at the current volumes for them to cover their short. Hello, tough day in the markets today. Hey, what's up, Nuke? We did talk about that a little bit at the start of the streams. I was kind of going into the CPI data and kind of giving my thoughts on that. Definitely very ugly, but frankly, it was definitely what I expected. It would have been nice to wake up to better than expected CPI data, but I'm also forever a pessimist, admittedly. But it was not too surprising to see the markets taking a dive, considering I definitely was expecting numbers at least somewhat similar to what we got. But anyway, yeah. So yeah, I would say that kind of finishing up my thoughts on the volumes and the shorting here, I would say that all this put together indicates a relatively good time to buy if you actually like the company itself in terms of just share statistics. Not talking about value, not talking about per placement in your own portfolio, strictly talking share statistics, volumes, and kind of short-term aspects like that. We see that there is high insider ownership. They've been buying relatively in the last 6 months, not huge amounts of buying, but they have been buying. The institutional ownership is relatively high, but that also means that the ownership is relatively blocked in, and also that the short outstanding relative to the float, because of the amount of shares taken off of the overall float, means that the short outstanding is actually relatively high, and the short ratio is relatively high relative to the short-term volumes being high over the 3 months. So overall, I would say that this is actually a pretty well-positioned share statistics for purchasing if you yourself like the valuation. But that is another thing, which we will get into now, kind of starting in with the segmentation as I typically do. I am treating them as part of the entertainment and broadcasting businesses. I'm basically just half and half entertainment and broadcasting for the segmentation. This is me kind of throwing them a little bit of a bone, not putting them as half entertainment and half software entertainment, which is similar to what I've done with a lot of the other streaming companies, partially because of just how small of a portion of their overall revenues are actually part of their streaming service so far. They are still mostly reliant on their traditional distribution and advertising revenues for the most part as it is. So that is giving them a little bit of a bone in the short term, which does help considering how much debt they have. But either way, that gives them an unlevered beta for the industry of 0.9 with the sales capital ratio of 1.13 in the most recent year. And that is $1.13 in revenues for each dollar of capital invested in the business, and adjusted net margin of 12.29% for the industry. They have about 14% of their revenues coming from Europe, about 80% coming from the United States, and about 6% from the rest of the world, with roughly similar percentages as far as the distribution of their assets, with a larger percentage of their assets being in the US relative to the revenues. But overall, that gives them an updated ERP of 5.5. They do have 286% debt to equity ratio, a huge amount of debt. I come up with about 3 billion or so, including their lease liabilities, at a weighted average maturity of 5 years. So a pretty okay amount of maturity, but not necessarily the greatest amount of maturity, especially considering how huge that debt is relative to the market cap. It comes in at an interest rate of 4.5%, which is actually not bad, all considered. But yeah, $3 billion in debt relative to their $1 billion market cap. So a huge amount of debt relative to the overall equity in their business, which gives them a levered beta of 2.84. So a huge amount of risk being pushed into their cost of equity as a result of that debt, giving them a cost of equity of 19%. But because of the fact that it is mostly debt, if you weight it all the way down to the weighted average cost of capital, it means the weighted average cost of capital, even though their cost of equity is 19%, the cost of capital ends up being only about 7.5%. So that's actually not all too bad, all things considered. So pretty fascinating to see, because usually when you see a company with that much debt, they often have difficulty keeping their cost of capital, the weighted average cost of capital, actually at a measured level. Usually by taking on that much debt, they end up going past the sweet spot where they can kind of finagle and still have a pretty decent cost of capital. And that's relevant because of the projections I have for the company, as we'll get into later, in terms of the returns on their capital and how that compares to that cost of capital. So anyway, taking a look at their 10-year history from 2012 up through 2021, you can see that they went from 1.3 billion up to 3 billion in revenues over the 10-year period. For the first 5 years, growing at a compounded rate of about 15 to 16%. So very fast growth for the period between 2012 and 2017, moving into a little bit more of a slower, more stable growth of about 2% or so between 2017 and 2021. So definitely a lot slower of growth, obviously taking a little bit of a dip in 2020 and then kind of recovering from that. And so this kind of, I guess, somewhat speaks into what I was saying before when I guess you could say my biases that I've kind of had observing this company throughout my investing career is because, like I said, I started investing in 2018, late 2018, and then really kind of went ham in 2019. And so kind of like I remember taking a look at this company and thinking about whether or not I thought it was a good value or not. And like I said, I had my biases against the properties and not really thinking that I thought that they would necessarily last, and so it would be the greatest opportunity. And so in one sense, as I was kind of saying, that I think that their franchises have actually done better than expected. But if you think in terms of the actual sales growth, obviously there hasn't necessarily been the greatest growth, at least over the last 3 to 4 years, which is a relatively short period of a history to kind of be judging them on. But either way, I think it does kind of at least lend into those biases to say that while they've done pretty good over the last few years, I don't necessarily think that they have a crazy amount of legs for growth moving forward into the future. As we were saying before, the growth of their streaming service is very much a cannibalization process for their previous businesses, and it's really just a transformation more than it is an actual growth revenue or growth avenue. And also, we can take a look at their gross margins. Their gross margins for the first 5 years of the historic period that we're taking a look at average 58 to 59% or so. And then for the next 5 years, they average about 53%. So you can also see a pretty dramatic drop in the gross margins over this entire time frame. Coming down to the adjusted net margins, we can kind of see a little bit of a wider, more varied look of it. The overall margins they've had over the 10-year period, averaging about 12.5%. And for the first 5 years that we've looked at, they average just under 13%. So a little bit higher than the overall average, but not really that far from the 10-year average, which means that the average for the next 5 years also therefore can't really deviate that far from it either, averaging really just about 12%. So you could say that over the 10-year period, it's kind of moved relatively slowly from an average of about 13% down to an average of about 12%, which does show that that kind of downward movement in the gross margins has effectively slowly moved its way into the net margins. And then also, obviously, that also comes off of the back of them having a huge amount of debt. So that is to say that if they didn't have as much debt, that they would actually have relatively higher margins. But also the fact that they have that much debt means that those margins are going to be suppressed in the future, which is kind of why I bring that point up. Also, I didn't have necessarily a whole lot of specific thoughts about how I wanted to guide for margins in the future. So I did kind of bring this little box over here to kind of do a little statistical analysis of the margins at play here. I did take the median margin, which the median margin is about 12%. And then I took the standard deviation of the 10 margins that I have here to find that the standard deviation is about 3.5%. So if we go 3 standard deviations below, which is basically encompasses the vast majority of potential outcomes under a normal distribution, it means that a pretty worst case scenario for the margins, at least according to this 10-year history, would be something around 2% or a little bit below it. And then 1 standard deviation above, which would be a relatively optimistic margin, would be around 16%. So I'm going to probably end up using those numbers for my projections moving forward. So I kind of wanted to at least point that out somewhat now. So it is a little bit of a conservative estimate, but that's something I'll be using later. Coming down to the cash flows, we can take a look at the free cash flows to equity, which gives us an idea of just what they could have paid out to the shareholders, net of debt issuances and paybacks, which you can see, for example, over the entire 10-year period, they've effectively had a pretty balanced amount of overall debt. On average comes out to be about 44 million per year in issuance. So effectively they've issued 44 million in new debt each year on average over the 10-year time frame. If we break that down over a 5-year time frame, you can see they're issuing more debt in the first 5 years, closer to 100 million, and then it was actually more like a pay down of about 6 to 7 million for the next 5 years. So for the first 5 years, they were issuing debt. The next 5 years, they've been effectively flat. They've really just been kind of balanced in their issuance and versus their pay downs, so to speak. And then overall, that itself turns itself into free cash flows to equity over the entire 10-year time frame of an average of just under 200 million per year or so. For the first 5-year period, it was about 75 million or so, and the next 5-year period was about 300 million or so. So you can see that the free cash flows to equity have increased, relatively speaking, which is interesting to see that they were increasing at the same time as they were no longer issuing the debt issuance, because usually you very much see higher cash flows when you're issuing the debt and then lower cash flows when you're paying the debt back. So the fact that they actually had higher free cash flows to equity when they were not, at least not issuing new debt, but they were not really paying down the debt at a very fast pace, means that there's other factors going into it that makes having to do with more of their capital expenditures. Which, for example, if we do take a look at the adjusted net capex line that I have right here, which includes not just capital expenditures, but also any acquisitions, divestitures, changeovers of working capital, as well as depreciation and amortization, all of it put in together into one effective number to encompass all of investment for the company. You can see that part, if we actually see for the 10-year time frame, it averaged about 164 million per year. So effectively, that's the kind of longer term average investment, so to speak, post of net income to get to free cash flows. For the first 5-year period, it was 285 million versus the next 5 years, it was 43 million. So they've done way less reinvestment in the last 5 years comparative to the period between 2012 and 2016. Which, you know, for better or for worse, you can kind of make multiple comments about that. On one hand, you could say that they haven't been investing for the future, but on the other hand, you could say that that's allowed them to generate cash flows. In fact, that's, like I said, that's exactly where this excess cash flows in the most recent 5 years compared to the first 5 years came from, which is why I was bringing it up. So anyway, we can compare those cash flows that they have paid out, which, what was it, for the first 5 years, it was an average of 74 million they could have paid out, and the amount that they did pay out during that time frame was 57 million. So they did not overpay their shareholders during the first 5 years of the historic period that we looked at, and then it was 308 million for the next 5 years, and the amount that they did pay out was 246 million. So still not overpaying their shareholders in the next 5 years. So that's pretty good to see, pretty good, considering just how important the balance of their finances really is with that much debt on hand. You really wouldn't want to see them overpaying their shareholders. That would be a huge red flag to see them doing a bunch of net treasury repurchases more than they effectively could repay due to their free cash flows to equity when they have such huge amounts of debt, but that doesn't seem to be the case for them. So we can come down and take a look at how these cash flows turn themselves into returns for the company. The returns on invested capital for the company over the 10-year time frame, averaging about 20% or so. For the first 5-year period, it was about 25%. So it has dropped down to about 15% for the next 5-year period or so. But that might have to do with the lower levels of free investment, and also that could be reversed over the next 5-year period, but we'll get into some of that. Also, the returns on equity are being a little bit more chaotic, partially having to do with the changeover. The huge amount of debt that they have has made that their statement of equity not necessarily always be consistently positive. There's some negative years in there, so the returns on equity are a little bit more chaotic and random, with some really large multiple hundreds positive and negative numbers in here, so the overall average isn't necessarily super meaningful. But in the most recent year, they have had at least a lot more stable of a balance sheet, so this 81 to 82% of a return on equity relative to the return on invested capital of 11%, at least seeing sort of the scale between the two, where you can see the returns on equity are several times that of the returns on invested capital. That is at least pretty representative, I think, of their capital structure as it is. Huge amounts of debt, small amounts of equity, but still managing to eke out returns relative to that. So coming down to their balance sheet, we can take a look at their actual assets in place and take a look at the debts and think about how we think of it in terms of each other. The cash on hand for the first 5-year period, they had an average of 426 million or so for the 5-year period. Over the next 5 years, averaging about 742 million, ending in the most recent year of 892 million or so. So a pretty significant amount of cash, constantly growing the amount of cash that they have on hand overall relative to the overall assets they have. Let's see, for the first 5-year period, the average amount of assets they had was 3.5 billion. So 3.5 billion in assets versus 426 million in cash, a pretty significant amount of cash. A little bit more than 10% of the overall assets was in cash for on average for that time frame, and then it was at 742 million for the cash for the next 5 years. The average amount of assets that they had for these 5 years was 5.3 billion. So even more so, the percentage of cash relative to their assets has increased for the next 5 years, and then 900 or about 900 in cash or so relative to 5.7. So it's effectively increasing consistently over the entire 10-year time frame. The cash as a percentage of their total assets is just increase. So yes, they have a huge amount of debt on hand, but their net debt effectively is probably getting better in terms of a percentage of their total assets. I don't actually have that as a specific figure in here, but effectively we just we just looked at all of the factors in that calculation, so we can kind of see that would be the case. We can also take a look at their accounts receivables, taking a look at like how people are paying their bills to them. We've had an average of 532 million for the first 5-year period. up to average of 838 million for the next 5-year period, which it ended at 884. So it's not ended that much higher than it was as an overall average for the last 5 years, which means that even though it has grown over the 10-year time frame, I would say that that growth seems to have slowed down overall. And we'll skip down overall to the liabilities to compare specifically the receivables to the payables. We can see that overall the amount of payables that they actually have is really small. The amount of payables averaging 74 million for the first 5-year period, averaging about 120 million for the next 5-year period, 173 million ending. So huge amounts of receivables relative to payables, which is really great for, stability of their balance sheet. It means that they at least have lots of assets to cover their liabilities. What it does mean, though, is that this kind of growth of receivables is a little bit of indicative of their weaker position in the business structure as a community. It means that basically the people who owe them bills aren't as fast to pay them relative to as they are to other people. And considering the people who pay bills to them are very much a lot of their consumers, a lot of their end consumers, that might mean that there's a little bit of a slowdown in terms of their ability to get their subscriber base relative to other people's. Popo Mojo, is the economy fucked? Well, I mean, it's in a rough position. It's in a rough position. I would say the economy as a whole is holding up better than I would have thought a year ago, going into all of these situations. Employment is still doing relatively well, and household balance sheets are still holding up relatively well. But we still have a lot of ways to go as far as like dealing with real pain and seeing how people handle everything. What about the EU energy crisis? I mean, it's exactly as you describe it. It's a crisis. I don't necessarily have too much specific comments on it other than we'll see just how bad it gets this winter. It's going to be rough. It's hard to say how that's going to affect everything because it kind of relies on a lot of government reactions in terms of like what different nations do to each other in terms of trade deals, pricing restrictions, and not to mention the kind of conclusions of the conflict. If the conflict comes to a conclusion sometime soon. Obviously it very well might not. It could just continue for a while. But anyway, kind of getting back into this. Also taking a look at their total current assets. You can see current assets for the first 5 years average about 1.4 billion. The next 5-year period averaging about 2 billion or so, which is about the same as it currently is. So the overall current assets have not necessarily grown too dramatically over the last 5 years, but they did grow at least somewhat significantly over the 10-year time frame. Comparing that much more specifically to the current liabilities, 1.4 billion up to 2 billion or so, we can come down to the total current liabilities. It was about half as much, 700 million or so for the first 5 years, and then the average for the next 5 years about 852 million. It means that the overall ratio is actually increased. So the current assets as a ratio to current liabilities has increased over the 10-year time frame, though it ended in the most recent year at about the same level, about 2 times. So at least that's pretty well covered. They have a pretty decent amount of current assets relative to their current liabilities. And as we had said, they have lots of receivables relative to their payables, and they have lots of cash relative to their overall assets. So obviously it gets down to the real question, the real problems, or not problems necessarily, but the real challenges that they have is the total amount of debt that they have. Well, obviously, at least taking a look at the long-term debt, you can see long-term debt 2.4 billion was the average for the first 5-year period, moving upward to an average of about 3 billion or so over the next period. So it hasn't necessarily grown too dramatically. It's grown kind of over the entire time frame, but not necessarily at a scale too dramatically different than a lot of the other assets and liabilities that we've kind of looked at on the balance sheet here. In fact, I did actually pull up ratios. You can see here that the total debt as a percentage of their assets over the time frame has moved from, in 2012, 84%. For the 5-year period, it averaged about 73%, up to the next 5-year period, it averaged 58%, and it ended in the most recent year at 52 to 53%. So there's been a consistent downward trend in the actual amount of total debt as a percentage of their total assets, which means, yes, they have a huge amount of debt. Yes, their debt has even grown over the 10-year time frame, but they've grown their assets at a much faster rate, or not much faster, but a faster rate, a faster rate. It has shrunken. So overall, yes, a huge amount of debt relative to their market cap, but relative to their assets, no. And what that means is that the market itself effectively just isn't valuing the assets very well. And that would show itself in a price to book ratio, for example. I also did pull up the total debt as a percentage of the market cap as it was listed at the end of the year.
So we can kind of compare that, at least relatively speaking. You can see that in 2012 it was at about 62%. It averaged about, oh, of course, this is going to be a little bit difficult for me. Hold on just a second. It averaged about 59% for the first 5-year period, and it's ended at, like I said, about 207% at the end of 2021, with an average of 153% for the last 5 years. So as their total debt as a percentage of assets has continuously moved down over the entire 10-year time frame, the market has completely and utterly rejected that as being a fact, essentially speaking. And you could argue about why this is happening. Like I said, they don't necessarily have confidence in those assets being valuable. They think maybe the book value of those assets won't really reflect the returns in the future. They don't think that there's a lot of growth to be had there. They think that they won't be able to pay down that debt and will have to roll it over into higher interest costs, which will lower margins. There's lots of arguments about why you could say about why the market is doing that, but it does show a large discrepancy effectively between what the market sees and what accountants see as far as the debt of this company. The market sees the debt as a huge problem, while accountants effectively think that the debt is just getting better and better over time. And then so we can also come down past the liabilities as a whole to the shareholders' equity statement, which I had already commented before when looking at the returns on equity about how the shareholders' equity for several years was in negative territory, which is what we were getting some erratic numbers there that weren't super meaningful in certain ways. And sure enough, yeah, we had shareholders' equity negative for the first 5 years of our historic period, averaging about negative 379 million or so. Even so, while the retained earnings had moved from negative territory in 2012 up to positive territory by 2016, but the average retained earnings over the entire time frame was still negative 300 million or so. And then over the next 5 years or so, the retained earnings then moved to an average of about 1.5 billion. It only actually reached that point in 2019, but still an average of 1.5 billion over the 5-year period, ending at about 2 billion or so, with the shareholders' equity itself ending at 851 million, with an average of 517 million over the period. So even so, like I said, the way accountants are looking at this company, it has gone from effectively a worthless company according to accountants to a company that has a true valuable book value according to accountants. And obviously, as I was saying, you can compare that to the market value and see that, for example, the price to book currently is less than 0.85. So that is exactly what I was saying before. The market believes that it is less valuable than accountants believe. Whether or not you yourself also agree with that is a different argument altogether. So we can come down to the sales to capital ratio, which is one of the other key features that's going to be important to our assumptions about future projections for the company. You see that the sales capital ratio has consistently kind of moved downward over the trend over time. It had a relatively high sales capital ratio in 2012, 2013, but that partially has to do with the low shareholders equity, the negative shareholders equity that we were just talking about, because that means the capital base was going to be relatively low compared to the sales that they were currently generating, and that had to stabilize over time by the capital base growing at a much faster base than the sales itself was, which is why the sales capital ratio came down over time. So even though it does start at 1.94, I definitely don't think that's very representative of a particular real reflection of their business. That was just a kind of outlier moment in time. Even so, the average sales capital ratio for their business for the first 5 years of our historic period was 1.26, 1.27 or so. And then that average moved over the next 5 years to an average of 0.91. That means 91 cents of revenue in the business for each dollar of capital invested in the business. That's what that ratio effectively means. In the most recent year, it ended at 0.93. And we can compare that to the industrial expectation for the most recent year that we had talked about when we were doing the segmentation, which was to say that the industry that they're a part of for the same measure is 1.13. So for the industry, they get $1.13 for each dollar of capital in the business. In the most recent year, AMCX got 93 cents. So they're not as capital efficient, at least in the most recent year, effectively compared to the industry that I'm comparing them to. And then also, I mean, I had also said that the average industry margin for the most recent year was 12.29%. And we can compare that to the margins that AMCX also received, which was 8.14%. So they have low sales capital ratio and a low margin relative to their industrial expectations, which is not very good. That's not typically what you would like to see. You would like to see your company usually having a strategic advantage, at least in one category or another. So not a very strong set of brands, that doesn't give them a huge strategic advantage in terms of being able to generate lots of excess revenue growth. I kind of said that that was my bias at the start, but I did think that that was going to play itself out in the numbers to a certain extent. This is the way in which that shows up in the numbers. We don't see strong margins for them. We don't see strong capital efficiency for them. The only thing we see strong for them is book value and potential returns relative to it, effectively speaking. So the only thing essentially to really note for the company is that it's cheap. So doing the same thing I did with the margins, which was taking a look at the overall median of it over the entire time frame, which is 0.94, and then also the standard deviation, which is 0.34, and then comparing basically a lower bound of that being 2 standard deviations lower for the sales capital ratio, not 3 standard deviations, which is what I did for the margin, because I do think sales capital ratios tend to deviate a lot less. Being lower, being 0.25, and then 0.5 of a standard deviation above that for the same reason. It's less volatile of a measure, gets me to 1.111. So those are going to be bounds that I'm going to be using for my future projections for the company. So we can get into my assumptions for the future projections of the company and how that relates itself into the value itself. Before I do get into that, I will say, if you are watching at this point, either live or on the replay, it'd be really appreciated if you give us a like. I see we already have a few likes, and I really appreciate my usual viewers and some newer viewers that are giving those, so really appreciate it. Also, if you're not already subscribed to the channel, it would really be cool if you would subscribe to the channel. It can also give you notifications whenever I go live or whenever I release other videos. That way you can come and join us when we're here live. Also, the pinned comment in the chat, as well as in the description below, is the link to the Discord channel that we have for the stream, which you can join, where we share daily news, our discussions about what's going on in the market, our ideas for our own portfolios, and analysis of different companies. So come be part of the discussions there if you would so like. So getting into the projections for the company, I was kind of trying to think about different ways that I wanted to project for this company. As I had said, I don't necessarily have a whole lot of super optimistic views about the brands and the franchises for the company, and my views about like where the revenues can go is probably going to be very basic and very simplistic and not really necessarily super sophisticated. So if you've got a lot of more specific knowledge about like how much subscribers you think they can grow, or how much viewership different franchises or newer shows that they have are going to do, good for you. You can apply that however you want. This is definitely more of a numbers focused kind of valuation. But even so, getting into this, I did try to kind of like think about different ways that I could do something to kind of build some sort of model for the numbers. And unfortunately, I didn't really come up with too much success here. So what I have here, while it is kind of neat to look at, and I'm going to share what I have here, it isn't actually super useful in terms of the actual projections that we have for the company. But even so, I did pull up the listed subscribers according to Nielsen that they have in their financials for the different broadcasting channels that are part of their main networks, being AMC, WeTV, BBC America, IFC, and Sundance TV. You can also see when they acquired BBC America and different particular parts of that. And I listed all these numbers here together. Now, I did know that there is going to be a lot of overlap between these, so I didn't necessarily want to like just take a total of all the subscribers across all these channels, because I didn't think that that would be super reflective of their revenues, since there was going to be large amounts of overlap due to distributional deals that they have with the company. So what I did is I actually took a correlation between AMC specifically, which is their home brand, and each of the other individual channels here to get an idea of just how well correlated the change in the subscribers for these numbers with the other ones. And I found that the WeTV is the most highly correlated with AMC. BBC America is the next most correlated. IFC is positively correlated, but only about 20%, so it's not a very strong level of correlation whatsoever. And then Sundance is actually negatively correlated, which is pretty interesting to see. So basically what that tells me is that WeTV and BBC America, I think, are effectively just bundled together with AMC, and you can consider those subscribers as being part of essentially the same grouping. That's basically what I was kind of using this logic to come up with. And so what I did is I then combined AMC with the other two categories that remained, IFC and Sundance, to get more of an idea of, I think, a real more representative set of subscribership in terms of how that affects the growth of their revenues as a whole. Which is these numbers right here, which, like I said, it's not a real set of subscribers. This isn't something you can use to like compare to like actual subscribers of other streaming companies. This is just an internal number for our own calculation. It's sort of like an average subscriber nominal ratio of sorts, if that makes sense. But anyway, so the point is I took the year-over-year number for that, the change in that particular number there, and compared it to the change in the revenues of the company itself, which we have in this line right here. So those year-over-year numbers right there, and I did take the correlation between those two, which is only about 17 to 18%. So also not a very strong correlation. I was like, wow, okay, that's not very good. And it is positively correlated, which is interesting because I did compare it to also, I was like, well, what if I just took a changeover in the AMC subscribers? Like, what about just the home brand? What if we just did the home brand AMC subscribers, which is like true subscribers, something that we can take home to the bank, and it's not just some weird made up number like I did with this one. Like I said, this is kind of a weird made up number. This is not. This is just straight up AMC. Let's correlate that with the revenues. It's basically zero. There's basically no correlation. So it's like, wow, okay, so that's not very useful. And then the only kind of useful, logical, rational correlation I got was this weird number correlation that I came up with, and it was only 17 to 18%. So basically what that means is that I didn't find any real useful relationship between the changeover in the amount of subscriberships between either their home brand or a composite of the representative numbers of their brand and the changeover of their revenues, which means I don't think the growth of their revenues over the last 10 years, because as we had shown in the historic histories, they did have significant growth in revenues over the 10-year period, but it doesn't seem to be particularly correlated with their actual programming base as a whole. And as we had said before, the growth of their subscribership in the streaming platform is really more of a cannibalization of their previous business, which means I'm not really going to use a projection based off of some sort of model for the growth of the company. I'm really just going to use a pretty wide band of sales growth centered around close to zero, but I'll give it relatively a slightly positive growth to effectively say that this is really just a growth of a mature advertising business, and that's going to grow at slower than the rate of the economy. So I give it kind of an expected growth rate of about 1% or so. I do give it a pretty wide band as far as the positive and negative potentialities as far positive and negative, because I do think that if they did have another hit series, they could spurt out another strong set of growth for another 5 years or something like that. I do think that's very, very possible. But just as likely, I think that those franchises that they've managed to eke out a larger amount of runway with than I expected over the last few years, those ones could also just fall off a cliff and drop down like a rock. In fact, I don't necessarily think either of those stories is even necessarily the most likely scenario. Another scenario that I had posited a little bit earlier in the stream was that they could themselves be a target for acquisition by one of the other larger players. And I definitely still think that's one of the more likely scenarios. So really, in some senses, what we're doing is trying to figure out a potential buy price in some ways relative to that. Either way, so that's my argument for why I'm not really doing anything super sophisticated with revenues. Pretty long argument to make, just to say that I'm not gonna do anything super fancy. If you have the ability to do something fancy, good for you. That's fine. I am going to use the last 2-year average of the revenues as a basing effect to kind of simulate a decline in the revenues due to a decline in advertising revenues over the next year or so, which would bring their expected revenues for 2022 down to 2.9 to 3 billion or so, relatively a little bit lower. Again, the expected numbers was about 3.1 billion or so. So I am in some ways sandbagging the short-term expectations, allowing them to then rise up into my longer-term expectations. Well, then, like I said, that may not have to do with 2022 numbers. Maybe that has more to do with 2023 numbers and me wanting to put that number in there somewhere. But as I've said in many of my evaluations before, this particular spreadsheet template has limitations as far as the ways in which I can manipulate the spreadsheet to do what I want it to do. But my future spreadsheet template, which I am indeed working on, and maybe I'll show some details about that at the end of this valuation, it does allow for much more flexibility in that regards. So anyway, coming down the line, to take a look at the margins. This is something that I kind of had basically already said what my methodology for what I was going to use was, which is that I took the median of our 10-year period, which was about 12.21%, and then the standard deviation during that time frame, which was 3.48%. And then I said the lower bound of my margins is going to be 3 standard deviations below the median, and then the upper bound was going to be 1 standard deviation above it, which is a pretty conservative approach to use, to 3 down and 1 up. but that's the conservative approach that I'm going to take, both partially because I do think that with a rising interest rate environment and with a not very large maturity profile that they have for their debt, that means that they very well might have to roll over their debt into higher interest rates, which would lower their margins, as well as they very well might have to do larger amounts of investments in working capital relative to the liquidations of working capital that they've done over the last year or two, which was one of the reasons that they had lower capital expenditures, as we talked about in the cash flow discussion. So I do see multiple reasons for why their margins will be lower in the future. But anyway, on an expected basis, that still gets us a median of about 9. I'm leaning towards 11, which gives me an expected basis of about 10%. And then I am also, with the revenue basing, I'm also simulating a decline in margins in the short term, a pretty steep decline in margins in the short term, partially off of the back of, like I said, a decline in advertising revenues and them not necessarily having a great positioning as far as bill paying goes, which comes back to what I was saying before about them having a pretty large amounts of receivables and them growing over time. So I don't think they're in a great position in terms of billing, which means that they will probably have lower margins relative to other players that can sustain their margins during a recessionary environment. So I do have the margins declining to about a quarter of the most recent margins in the short term, and then bouncing back up towards the 10% over the long term, which is, like I said, has a definite declining effect to the overall valuation. For example, if we just like remove that one factor, my expected value itself would jump up by about $5 or so. So that does have a pretty significant effect on the valuation. You could argue that that's an unnecessary factor to include, but that's one way in which I'm going to be conservative in my assumptions here. So coming down to the sales capital ratio, which, like I said, I'm the same methodology. I'm essentially using the median, which is 0.94, and then 2 standard deviations below that gets me to 0.25, and then half a standard deviation above that gets me to 1.1. And so that's the range I'm going to use for the sales capital ratio, leaning towards 0.8, which gets me an expected ratio of 0.86. So I'm assuming that it goes from 93 cents in revenues for each dollar invested in capital down to 86 cents of revenues for each dollar invested in capital, which reflects the assumptions I was kind of just saying, that I do think that they need to invest more in content for them to be able to grow the revenues, even as much as I argue that they will be able to do over the 5-year period. Otherwise, they won't be able to grow their revenues, and that's the other argument. But even so, I do think their sales capital ratio is going to continue its downward decline that's been moving overall. I do think that they have a relatively weak position in terms of sales capital ratio compared to their industrial expectations. And so the only other major assumption, which is a pretty major assumption for this valuation, considering how much debt there is in the company, as we had said before, their current debt to equity ratio is currently about 286% if you include lease liabilities. I'm gonna make their range go from 450% to 100% in the best case scenario, and I'm gonna have it lean to 275%, which on an expected basis gets us 275% for the debt to equity ratio. So effectively speaking, I'm not really assuming that the debt to equity ratio goes down that much. It goes down a little bit, but that has to do more, I think, with movements in the market cap more than them paying down their debt. I don't think that they will pay down their debt. They've shown actually that they are more likely to issue more debt over time. It's just that they will at least not do it at such a rate that it grows relative to their asset base. So that's the one thing that we've shown, is that they don't seem to care at all what their debt's like relative to their market cap as a management. They just care about their debt relative to their asset base, which, I mean, at least they care about one of those things. Like I said, I don't necessarily think it's a huge problem per se. You just have to be comfortable with the risks associated with it. But the fact that, as we had said, the Dolan family has a 79% voting control of the company, and they've had that control for 10 years, and they've had this much debt for 10 years. There's absolutely zero reason to believe that they would change that management in the future. So it would be silly to change that assumption in the valuation. So associated with that huge amount of debt is going to be a pretty significant amount of default risk, which we do calculate to be about 3 to 4% per year on an expected basis, which I was talking about how that relates to my Zim valuation from a week ago. At the start of the stream, I was kind of comparing that to some of people's comments on the default assumptions there. So this to understand like just what this means. It doesn't necessarily mean that the company's going to go out of business just because a company maybe defaults on its debt. It just means that perhaps the equity investor gets wiped out in the process while the company gets reorganized. So just because I'm saying that there's a 4% chance of default in any given year in the next 5 years, which can equate to possibly somewhere in the vicinity of 20% of risk of default over a 5-year period on an accumulated basis, that doesn't necessarily mean that the company itself is going to disappear. It's just something that has to be understood, because apparently that was misunderstood in a previous valuation of mine. So all these assumptions together, that basically gives us our entire valuation. We can come over to the summary page and take a look at everything. And one more time before I get into the final valuation here, if you're watching either live or on the replay, please give us a like. It's very appreciated if you can give us a like. It helps attract more viewers to the channel. And if you're not already subscribed to the channel, please subscribe to the channel. That way you get notifications whenever I go live, and whenever I release any other video content. And if you haven't already joined the Discord, the link is in the pinned comment in the chat, as well as in the description below. You can join the Discord to be a part of the conversation, where we discuss our opinions on different companies and analysis thereof, movements of major investments, our own portfolios, and also even sharing memes about the stock market and things like that. So come be a part of the discussion there. AMCX, AMC Networks, U.S. Treasury currently selling today at 3.41% or so. Mature market equity risk premiums, as I currently calculate it, is 5.32%. The discount rate that I'm using for AMCX, after you adjust for the company specific risks, including the massive amount of debt that they have as a company and the business that they operate in, as well as the geographies that they operate in, it gets me to a discount rate of 19% or so. They do not have a dividend. They do have share back authorizations we discussed, but they do not pay a cash dividend. 5 years ago, they had sales of 2.7 billion or so. In the most recent year, it was about 3 billion, and that equates to sales growth of just over 2% or so for the last 5 years as a whole. The sales capital ratio in the most recent year was 0.91 compared to the industrial expectation of 1.13, and they had returns on invested capital over the 9-year period average on a rolling basis of about 20% or so, which is pretty strong, and debt to equity ratio currently of about 286%. Which equates to default risk in the most recent year period of about 2.77% or so. The profit margins that we are expecting for the basing of our valuation in the most recent year is going to start at around 2%, which is a quarter of the most recent year margin. They actually had about an 8% margin in the most recent year period. And that compares to the industrial expectation of 12.29%. So they have lower profit margins than their industrial expectation, and they have a lower sales to capital ratio than their industrial expectations, which means that they have a relatively weak competitive position compared to their industry, at least according to those metrics. Profit in the most recent year is 251 million or so, and they have a sales price currently of $23.77 per share. The probability distribution that we're using for the company is our pretty typical standard distribution, with 35% of the probability case in our median case third model. Our sales expectations is anywhere from 1.7 billion in the worst case scenario to possibly 5.1 to 5.2 billion in the best case scenario. On an expected basis, I see 3.2 billion. That equates to sales growth of anywhere from negative about 11% or so in the worst case scenario to possibly about positive 11% in the best case scenario. On an expected basis, we see about 1% or so. That's per year on a compounded basis. The sales capital ratio on an expected basis I have is 0.86. That it's 86 cents in revenue for each dollar of capital invested in the business. And that comes out to returns on invested capital across the sums of assumptions here. We have about 8.7%, which, if you remember, when we were covering the cost of equity and the weighted average cost of capital, they had a cost of capital currently of about 7.5%. So even across all of these assumptions, with not even that great of growth, grade of capital or grade of margins, we do essentially see that they will likely be achieving returns on invested capital higher than their cost of capital, which is excess returns. Debt to equity ratio, we have a pretty wide range of assumptions for the debt to equity ratio, but overall on an expected basis, we see about 275%, and that equates to a default risk of about 3.88% per year over the 5-year period. So that equates to somewhere between 15 to 20% chance of default. Again, that doesn't necessarily mean that the business goes out and fully ceases to exist. That just means that there would be a restructuring of the debts that would likely wipe out the value of the equity. So there was kind of a misunderstanding, I think, in some of my more recent valuations as far as like what this is supposed to represent in terms of like how that affects the value of the company. It's not necessarily that the company disappears. It means that you yourself, the equity investor who gets paid last after the debt holders, might have nothing left over as a result of that. So you have to adjust for that, the risk of that happening in certain circumstances. Anyway, so there's a profit margin distribution that I have here of anywhere from 2% to 16%. On expected basis, I see about 10% or so, and that equates to profit distribution of anywhere from 35 million in the worst case scenario to possibly 831 million in the best case scenario. On expected basis, we see $327 million in profit, and that's not free cash flow, that's profit before reinvestment, which you can figure out the numbers of, including the sales capital ratio. That include after adjusting for the discount rate across the varied models that we have here, equates to a present value price of $32.21 per share, which is 35 to 36% higher than the current share price. We have 5-year forward value targets unadjusted for the dividends that they could theoretically pay out during the time frame of anywhere from worst case scenario $7.96 per share to possibly best case scenario $283 per share. On an expected basis, we see $76.94 per share, which if you compare that to the current share price, gets an implied return of 26.48% per year. So pretty substantial potential returns here. I have a value score here, which takes into account best case and worst case scenarios comparative to relative potential market returns of 1.04, which is a pretty strong value score, which means that yes, there's lots of potential worst case scenarios here, but the best case scenarios seem to far outweigh those potentialities. I would say that the overall margin of safety comparative to those returns is not super great, and that has to do with the fact that the discount rate that we have here is just so large. So even at fair value, you would expect to get a 19% return. So it's like, even though you think 26, 27% sounds like really great returns, the truth is that really, you're supposed to be getting 19% of those returns because of just how much risk there is associated with the stock, particularly because of the debt, like the debt being the biggest factor there. So yeah, huge potential returns, but most of those returns are just risk adjustment. There is still lots of upside to the value, as we can see here, 35 to 36%. But I would say that considering how much risk there is associated with the debt, I don't think that that's enough returns to make me particularly enticed into the stock. I do think that the finances of the company are very well managed, and the fact that the balance sheet relative to the debt is so better reflected relative to the market cap does make me look twice at this one a little bit more than some of the other higher default risk valuations that I've done recently. So while I'm not necessarily super enthused into jumping into this one right now, I do want to kind of look closely at this one in the future, because if these returns are this high now, it's very unlikely, I think, that they're going to change that much in the short term, especially with the market, I think, having lots of potential negative downside in the short term, and maybe in the future. So even though, like I had also started at the start of the stream, I was talking about the share statistics of the company and how that relates with the current most recent volumes, the insider holdings, as well as the short outstanding. I did say that I did think that it's currently a relatively good time to be buying the stock if you did want to buy the stock. And it shows here that the value is a pretty good time. But like I said, there's just some risks and uncertainties that I think that would be better looked at more closely than in the relatively short amount of time that I devoted to this valuation here. Specifically, like I said, there's a huge amount of debt, and so you might want to take a closer look to be a little bit more certain about whether or not you really do think that those debts can be managed over the time frame. They did have this new CEO, Christina Spade. It would, while I do think that an accountant taking the helm is probably a good thing to have for a company whose valuation is so heavily dependent on the management of debt, I do think that the fact that she's so new means that you might want to give her a little bit of time to show that that is actually going to be the focus of her, that is managing those margins, rather than, like I said, just sustaining the debt levels, because the family holders don't seem to care too much about how much debt the company holds, shown by their history. So that is a long way to say that even though there's some higher potential returns here, I'm going to be passing on it, at least in the short term. Though, like I said, I am at least interested enough that I'll probably maybe be continuing to do some further dives on this, and I'll probably be paying attention to its next earnings and the earnings after that, because I will be curious to see how this new CEO performs, as well as I'll be curious to see how some of the newer programming as well as other spin-off programmings will perform relative to their predecessors. So that's going to do it for the AMC valuation here today. I didn't actually already put it here into the watch list, but as we were just saying, it is a value score of 1.04, so we can kind of see that it falls in line with in between here, between T. Rowe Price, Sportsman's Warehouse, Boise Cascade, and kind of Micron, in that kind of range as far as valuation scores, in terms of comparing best case, worst case scenarios, relative valuations, absolute valuations, all of those metrics together into this value score metric that I like to use. So that's kind of like the companies I think it compares to, relatively speaking. And so that is basically going to do it for our stream today. I do have only one particular company in the short term that I am planning to do, which is the stream that I'm probably going to have on Thursday, is SMCI. Supermicro Computers is a company that we have covered on the channel before, and it is here on our watch list, but they recently did their 10K, and so I'm looking to do an updated valuation of that company, because typically speaking, once it gets to about a year old in the valuation, I either want to drop it from the watch list because it's considered dated information, or update it. So for SMCI, I think I want to keep it, and I'm just going to update the valuation. So that is what I think is going to be the next valuation on Thursday. Beyond that, I'm not 100% sure what is going to be next on the docket. I have a few other valuations here, the ones listed red, that are the ones that are a little bit dated and need some updating, but some of them I'm still waiting for those reports to be coming out, so it's not necessarily that I can necessarily hop on those super immediately. So if you have recommendations for companies that you would like to see me value, you can comment them in the comments below. Also, you can join the Discord, as I've commented a couple of times before. The link is pinned in the chat as well as in the description below. You can join the Discord to get a little bit more of a direct line of communication with me. You can have your suggestions added there. Also, before I go, one last cry and plea. If you're watching, somehow you made it all the way to the end here, bless you, bless your kind soul. But please give us a like, and please subscribe to the channel if you're not already. All right, I'll catch you all again next time.